Welcome back to Portfolio, everyone. In today's video, we're doing a stock battle between Visa and Mastercard to determine which dividend growth stock is the best buy right now and which one we believe will outperform the other over the next coming years. So of course, these are two companies who are direct competitors. They operate worldwide and they of course generate revenue doing very similar activities. So Visa and Mastercard are huge competitors and they are market leaders in their industry. And today we're going to do a direct comparison of some key financial metrics to determine which one may be the better buy right now. So we're going to go through each company's price chart, their historical 5-year performance, and then do a quick battle to determine which one has current ratios and current financial metrics right now that are more attractive than the other, and which one may be the better buy for our portfolios. So every single Saturday, we do a stock battle between two companies. If you have two companies you'd like me to compare and do a battle on, please leave those thoughts down in the comments and I will definitely take a look. And of course, everyone, as you know, I'm the Gen Z investor. Every single day on this channel, we make new videos that talk about different stocks you can buy, overall stock market performance, and any other big stock market news and headlines. So please like and subscribe. We're going to get right into this battle between Visa and Mastercard. First thing we're going to take a look at is the price chart for each of these companies. So Visa, ticker symbol V, currently trading just shy of $200 a share. On the 1-year price chart, you can see they're up 16%. So they saw March lows and they have actually not recovered back to pre-pandemic levels. Pre-pandemic level at around $213 a share, currently just shy of $200. 52-week range on the high side, but nowhere near that all-time high right now. If we move over to a little bit of a longer-term perspective, you can see here they're up 161% on the 5-year chart, so beautiful long-term share price appreciation with Visa. If we jump over to the other battler, you can see Mastercard, ticker symbol MA, at $330 a share. 1-year chart, they're up 27.7%. Once again, they saw pre-pandemic high around $340 a share, and they have actually not recovered back to that level just yet. 5-year chart, they have a nice price appreciation of 233%, which is absolutely incredible over the past 5 years. Now we're going to jump over and take a comparison of how these companies have performed over the 5-year with regard to total return. So that's dividends included with their share price appreciation to see which one has actually outperformed the other over the past 5 years. If we jump over to take a look at Visa first, their total return over the past 5 years was 174% compared to the overall market return of 76%, and this is with dividend reinvestments included. So you can see here, Visa has more than doubled the market's performance over the past 5 years, which is absolutely incredible. So 174% total return for Visa over 5 years. If we jump over and take a look at Mastercard, you can see here their 5-year total return is 250%. So they've more than tripled the total market return and have significantly outperformed Visa over the past 5 years, 249% compared to Visa's 174%. So over the past 5 years, Mastercard has been the winner, grossly outperforming Visa. So if you were a holder of Mastercard from the same time 5 years ago, Mastercard would have been the winner. So that's the two companies' 5-year historical performance, but of course that is great, but we are looking to see which companies are going to outperform moving forward and which one at the current valuation has better financial metrics because we're buying now, we're not buying 5 years ago. So we're going to jump over to our comparison and our battle chart. The first thing we're going to take a look at is market cap. So this is probably the least important factor of this battle, but what I like to show is to compare, to give a little bit of a relative aspect when you take a look at other metrics. It's important to know the market cap. If we were comparing companies on two completely different market caps, then it'd be unfair to compare, with different revenues because some companies generate more revenue and have a higher market cap, so it makes sense. So with regard to market cap, Visa is the larger company with a $417 billion market cap compared to Mastercard with a $328 billion market cap. So even though these are both extremely mega cap companies, some of the largest companies in the world, Visa does win this first battle. It is the larger company with the larger market cap. The next battle we have to take a look at is what we like with dividend companies, especially growth stocks. So we want to see companies who generate lots of revenue. That's what people in business for. Businesses are created to make money and generate revenue. That's the whole idea of businesses. So the next battle we have to take a look at is which company actually generates more revenue. So in most battles, people think the company with the higher market cap generates more revenue. That is not always the case. In our last week's battle between Coke and Pepsi, Pepsi has the smaller market cap, but generates 30 billion more revenue than Coca-Cola with a smaller market cap. So that's why I do include revenue, and I actually don't do a comparison directly between market cap and revenue, only because smaller companies can actually generate more revenue than larger companies. But in this case, Visa has $23 billion in revenue in 2019 versus Mastercard's $16.9 billion. So absolutely incredible revenues from both companies, but Visa does take this battle. Moving on, of course, on the income statement, you have revenue at the top, and then the last line, of course, the very important line is net income. How much income or profit is being brought in by these companies? And in this battle, Visa does take this one once again with $12.1 billion in profit in 2019 compared to Mastercard's $8.1 billion. So of course, these companies are generating insane amount of profits compared to their relative revenue. So if we take a look at profit margin, you can see here that these companies both have insanely high profit margins. Visa's profit margin in 2019 was 52.6% compared to Mastercard's 48% profit margin. So even though Visa does win this battle once again, these are absolutely insane profit margins for these companies. Most companies dream of hitting net income levels compared to revenue and profit margins of these numbers. Like, so many companies in the world cannot achieve this type of level of profitability that Visa and Mastercard are doing. These are insanely profitable companies that are doing very well. So Visa does have the slightly higher profit margin in 2019. So they have the 4-0 lead to start this battle. Of course, there's other aspects of a company. So it's great that Visa is generating more revenue now. But which company is actually growing revenue at a fast rate over the past 3 years? And Mastercard wins this battle and they get their first win of this battle. You can see here Mastercard has a 3-year revenue growth average of 16.17% compared to Visa's 15.15%. So again, both of these companies have insane revenue growth over the past 3 years, but Mastercard slightly beats out Visa in this battle. So far, these companies have just shown that with regard to their income statement, these guys are posting up massive numbers. These companies are generating huge amounts of revenue with an insane amount of profit, with insane profit margins, and they've actually both been growing revenue at very high double-digit numbers over the past 3 years, which is absolutely incredible to see. Moving on, the next battle we have to take into account is PE ratio. So of course, PE ratio indicates how much investors are willing to pay per dollar of company earnings, and this is a forward PE. So the lower the PE ratio is the one who wins this battle because investors are paying less per dollar of company earnings, essentially meaning that the stock is cheaper. So in direct comparison between these two competitors, Visa is currently trading at a forward PE of 39 compared to Mastercard at a forward PE of 49. So currently, Visa is the one to get in with the cheaper PE ratio. So Visa is so far winning this battle, but let's continue right on with another key metric, which is dividend yield. So of course, as dividend investors, we love collecting that consistent cash flow from our companies, and we love companies who grow that dividend each and every year. Of course, when we take a look at these dividend yields, Visa at 0.61% compared to Mastercard's 0.49%. These dividend yields are almost minimal. They're extremely low. They're almost like non-existent. But of course, with these types of companies, you're buying these companies for the share price appreciation. And you're also buying for the dividend growth. You're not buying it for the current yield. These are not companies where you buy today and you say, I want that dividend income this year. These are companies where you buy now, you want that share price appreciation to grow at double-digit rates over the next coming years, and you want that dividend, even though it's small right now, to compound and grow at a faster rate compared to a high dividend yielding stock on the market. So Visa wins this battle. They do have the higher dividend yield right now. But moving on to, of course, we take a look at current yield. How fast are they growing that dividend? So we take a look at the 5-year dividend growth rate. Insane, once again, 5-year dividend growth rates between both of these companies. Mastercard has a 5-year dividend growth rate of 24.57% compared to Visa's 20%. So Mastercard wins this battle, and they are growing their dividend at a faster rate than Visa. So even though they may be paying a lower starting yield right now, they are doing a better job of growing that dividend each and every year. But once again, both of these companies are posting amazing numbers. A 5-year dividend growth rate for both of these companies of over 20% is absolutely incredible. That is amazing to see, and I hope these companies can continue to grow their dividend at that astounding rate each and every year. Moving on, of course, with dividend growth rate and dividend yield, we got to see how safe that dividend is. So I get this dividend safety rating from a website called Simply Safe Dividends, and of course I use this to evaluate if companies can sustainably pay and grow that dividend each and every year. The highest possible rating a dividend can receive is 99, which is the very safe rating and is the highest safety rating you can get. So you can see here both Visa and Mastercard are ranked 99. So very, very unlikely that that dividend gets cut anytime soon. They post the highest dividend safety rating possible. Both of these companies pay very safe, sustainable growing dividend that will probably not get cut anytime in the near future. Moving on after dividend, now we're going to take a look at payout ratio, and we're going to take a look at earnings per share payout ratio first, And our second metric is going to be free cash flow payout ratio. So of course, when we take a look at a dividend, of course, these companies are lower yielding stocks, so dividend payout ratios are expected to be low. But of course, we want companies with lower payout ratios because that means there's more money to grow the dividend, and there's also more money staying within the business to grow and improve operations, which allows people and the company to generate more revenue, which of course brings in more income, which of course allows them to, in the future, grow the dividend even more. So the lower payout ratio wins this battle, and of course, both of these companies have extremely low payout ratios right now. 22.8% for Visa compared to 21% for Mastercard. Mastercard wins this battle with the lower payout ratio, but once again, this battle is extremely close, very low, extremely sustainable payout ratios, a lot of room to grow the dividend and grow the business. Both of these companies will have no problem paying out that dividend anytime soon out of earnings per share. The next payout ratio we're going to take a look at is free cash flow per share. A different type of payout ratio, but another important metric to take a look at. Mastercard wins this battle once again with a 19.6% free cash flow payout ratio compared to Visa's 22.3%. Once again, I'm going to repeat myself again, very low, very, very sustainable free cash flow payout ratio. And why this one's important is because companies are actually paying their dividend in cash. So you have to take a look at how much free cash is getting generated per share and how much free cash is actually being paid out as a dividend per share. So very low, very sustainable payout ratio in earnings per share and free cash flow for both of these companies, but Mastercard actually does win these two battles with the lower ratios for both metrics. Moving on, the final battle we have to take a look at today is with regard to the balance sheet. So we took a look at the income statement, the dividend, how these companies are paying out their earnings from the cash flow statement as well with regard to free cash flow. Now let's take a look at the balance sheet. So the current ratio is the comparison between a company's total current assets, so assets which can be liquidated in 12 months, compared to company's total current liabilities, which are the liabilities, the debts owed for the company within 12 months. And you can take total assets, total current assets divided by total current liabilities to get the current ratio. So you want a higher current ratio. The higher the current ratio, the better. So you can see here, Mastercard has a 1.96% current ratio compared to Visa's 1.55 current ratio. So Mastercard wins this battle with the higher current ratio. That just means Mastercard has 1.96 times total current liabilities as total assets, so they can pay off all of their total liabilities and still have a lot of total current assets on hand in order to deal with the business, grow the business, continue to operate the business. So that was our battle between Visa, Microsoft, and Mastercard. So Visa won 1, 2, 3, 4, 5, 6, 7 battles. Mastercard won 1, 2, 3, 4, 5, 6. So 7-6 win for Visa. Extremely close battle here today. Both of these companies have insane financial statements. They've done a beautiful job of growing the business year in and year out. They both grossly outperformed the market over the past 5 years. And in my personal opinion, I believe they will both continue to outperform the market moving forward. Both of these are extremely solid companies. They can both be part of a nice portfolio that includes growth with nice dividend compounding. Even though that low starting yield, I believe that dividend and your yield on cost will compound very nicely because they are doing an insane job of growing their dividend each and every year. Both of these companies operate in a business where it's only growing and in a market that is only growing. And I think Visa and Mastercard as the market leaders isn't going to change over the next 5 to 10 years. Both of these companies have such strong operations, such strong moats that I believe they're going to continue to grow moving forward. So if you had to choose one and you were going strictly off these quick current financial ratios, Visa does win this battle. But of course, there's so much more comparison you need to do if you want a full, deep analysis. This is just a quick comparison, a quick stock battle. It would take hours and hours and hours to do a full in-depth comparison of everything regarding these companies and how they generate revenue and how they generate their income. But if you're looking for a quick battle between Visa and Mastercard, Visa wins 7-6 today. Look forward to seeing you in tomorrow's video. Like I said, we post daily videos on this channel, and tune in next Saturday for the next stock battle. Leave your thoughts in the comments down below on which two companies you want us to compare, and I will see you in tomorrow's video.